Thanks very much, Phil. We appreciate your time. And of course, we look forward to you joining us again for the panel discussion shortly. Our final speaker for today is Mike Lawrenson from Laurium Capital. Mike is a co-portfolio manager of the Nedgroup Investments SA Equity Fund. Laurium takes a fundamental bottom-up approach combined with a macroeconomic overlay, as well as taking advantage of special situations in order to deliver outperformance for clients. Go ahead, Mike.
Thank you, Anil. Good morning, all. Welcome to the third quarter update for the Nedgroup SA Investments SA Equity Fund. So this slide just provides a backdrop for the year to date, as well as the quarter to date. We had a very strong quarter in SA markets in the third quarter, and you can see the Nedgroup SA Equity Fund performed nicely, returning 17.2% for the 9 months versus the capped SWIC index of 15.9%. Within the SA markets, domestic SA equities performed very strongly, returning 24% over the period. Non-resources ran hedges 14%, and the Resi index lagged at 3%. It was also a strong performance for the Rand. The Rand returned 6% for the 9 months, and it's weird, but it's not often one can say that the capped SWICs matched the S&P 500 in US dollar terms. Looking at the performance for the fund over the quarter and the year to date, you can see we've nicely outperformed both the general equity category as well as our capped SWICs benchmark. The prior year was a little bit of a poorer year. We struggled in the fourth quarter, and that has obviously impacted our 3-year and 5-year returns. What is pleasing to note, if you look in the sort of bottom line there, on a rolling 5-year period, we have, on average, outperformed the benchmark 80% of the time. This is a slide in the green. The green line is the Nedgroup performance since inception. The pink line is the SA equity category, and the white line is the capped SWICs benchmark, and you can see we've nicely outperformed since inception. Attribution for the 9 months. Fashini performed strongly over the period. It's our preferred play in the retail space, and that came through nicely during the year. Our overweight banks positions via ABSA, FirstRand, and Nedbank also performed very strongly, and it's pleasing to note that Remgro, which is a new addition to the fund in the last 6 months, has also performed nicely. Finally, on the sort of positive contributors, it's worth highlighting AngloGold, which has come through nicely during the year because it was one of our stocks that underperformed the gold peer group last year. On the relative underperformance, it's nice to see that bar Sasol, all of the relative underperformance is from stocks that we didn't own, like Capitec Bank, Harmony, and ShopRite. Capitec Bank, it's one of those quality compounders, but we remain concerned around rating and valuation. Turning to portfolio positioning, in terms of global consumer exposure, we've taken it via Nussperson process. We believe that with the new CEO in place, there are further opportunities to narrow the discount. There may be 1 or 2 IPOs of the underlying unlisted investments in the medium term. And then on Tencent itself, we remain positive on the outlook for earnings growth, largely driven by margin expansion, and obviously the share buyback continues. AB InBev is a new addition to our top 10 holdings. The beer sector has underperformed recently. We are, however, of the view that AB InBev is likely to beat the peers. We anticipate to see margin recovery, largely on the back of COGS deflation, and further de-gearing of the balance sheet will drive mid-teens earnings growth. British American Tobacco is a stock that we own. We did sell during the quarter. We still like it, and the valuation is underpinned by a 9% dividend yield. Bidcorp is a food services business with diverse exposure to Australia, New Zealand, the UK, and Europe. It's got strong cash flows, strong balance sheet, and we like the earnings outlook for that business. In terms of our South African exposure, we've taken it via SA Financials. We like the valuations, we like the dividend yields. We think that the declining interest rate environment that we're expecting should be positive for banks. And there, our big holdings are ABSA and FirstRand. And then we've taken selective exposure via in the insurers via Sanlam and Momentum. Some other South African stocks that we own, we've obviously owned Foschini and Motors for a while. But we've recently added in the last quarter to both Woolworths, Bidvest, and Remgro. We think all of these stocks should benefit from any uptick in the SA macro environment. And then finally, looking at our resource exposure, we remain overweight Anglo-American. We believe that its exposure to the top three or three of the top 10 copper mines in the world, it's a commodity. We think that over the medium term, the supply growth is likely to be constrained, while demand is likely to surprise on the upside over that same period. We also own AngloGold, which in our view is the most attractive in terms of valuation, expectations around production growth, and unit cost growth going forward. Looking at the overall portfolio composition, just briefly, the left-hand pie chart shows you the global consumer exposure at around 30%, SA banks at around 20%, and general retailers at 8%. We then have a resource exposure, and I guess the key ones to highlight there are the diversified miners, the non-precious resources mining, and gold, where we have what we think is quite a significant weighting at 7%. On the right-hand side, just another way of looking at it, it's effectively a look-through based on either geographic or currency exposure, and you can see SA shows up as 35%. However, on our analysis, on a beta-adjusted basis, it's probably closer to 40% and more in line with the CAPS benchmark. Turning to our top buys and top sells over the last quarter, you can see our top three buys have been Bidvest, Woolworths, and Remgro. They are sort of increasing our exposure to SA Inc. We believe that they are well positioned should we see the SA macro surprise to the upside. As I mentioned earlier, I won't go into the detail, but we've added to Anheuser-Busch. And then Goldfields, it's a stock that we've been underweight. We've been largely concerned on a valuation basis, and also concerned around the ramp up of Salares Norte, their new gold mine in South America. And more recently, I think it was late August, it came up with firstly its first half results and a production update where they significantly cut guidance for Salares Norte. And as a result of the underperformance in the share price, we added to our Goldfields positions. On the right-hand side, you see our top sells. Largely, BAT and Foschini were sold on the back of strong price performance in the quarter. We continue to own both those stocks, as we do FirstRand and ABSA, but based on share price outperformance, we've rotated some of those holdings into the ones on the left-hand side. Turning to the top 10, you can see that despite the four sales that I mentioned earlier, being FirstRand, ABSA, Anglos, and BAT, they still form part of our top 10 exposure. And the new additions are Anheuser-Busch, Remgro, and Bidcorp, which I've also touched on earlier. Okay, turning to the outlook, we remain cautiously optimistic on the outlook for SA equities and the broader macro South African environment. We think that the GNU creates a more positive political environment, and as a result, we think there are there is a risk to the upside on economic growth in the next 2 to 3 years. Coupled with the expectation that we'll see at least another 125 basis points of interest rate reductions over the next 24 months, we think it bodes well for the outlook for SA. Obviously, load shedding seems to have come to an end, and I'll show you a slide on that. And then the logistics constraints. I think we're over the worst. Things seem to have stabilized there, and with the help of the private sector, we should see an improvement over the next 3 years. Given the expectations of a weaker US dollar going forward, and the more recently announced China stimulus, we think this should be supportive of EM assets, including South African assets. So just on the SA GDP growth rates, ignore the green line because 2024 is pretty much a thing of the past, but focusing on 2025 in the orange line and 2026 in the yellow line, you can see growth in South Africa remains anemic at around 1.5% to 2%. Our view is that there is the possibility that this surprises to the upside, and it will be, be quite awesome if we can achieve 2.5% to 3%. That'll lead to a lot of business and consumer confidence, and it should bode well for corporate earnings. Just on Eskom, the green slide is the energy availability factor for 2024. The yellow line is the prior year for 2023, and you can see there's been a significant improvement in as Eskom's own plant performance and less unplanned outages have improved. On the infrastructure side, as I mentioned earlier, I think the constraints are easing. You can see the left-hand side, the rail volumes have certainly bottomed and moving in the right direction. It will take some time, as I mentioned, to get back to those original or those historic levels, but I think we're heading in the right direction. And on the right-hand side, you can see port delays continue to improve. This is a slide that Melanie Stockett, our fixed income manager, likes to show, and you can see it's the virtuous circle. As soon as you start seeing stronger currency, lower inflation, it leads to high investment, job creation, and ultimately you get rating upgrades, etc., and you end up with the investor confidence, and it just feeds on itself. And I think we're entering an environment where, for the first time, we're going to start seeing positive upgrades to economic growth. Finally, looking at this is our proprietary domestic SA index that we show, and you can see since the elections, we've re-rated significantly from we were more than one standard deviation. In fact we were close to 2 standard deviations below the long-term average, and we've actually returned to the average in the last 6 months. Having said that, we're still optimistic that we could see further re-rating, and there's also the possibility that we see earnings upgrade. So there's not only the earnings upside, but we think that there's upside to rating as well. And then on this final chart, you can see that the MSCI SA in the orange line at the bottom still trades at a significant discount to both the emerging market peers, the European peers, and obviously the S&P 500. So yes, we remain optimistic on SA equities, and we think the fund is well positioned to take advantage of that. Thank you for listening to me, and back to you, Anil.